In recent months, a quiet but highly significant preparation for a shift in the strategic balance has been unfolding on the geopolitical stage. And if anyone still believes that everything remains as it was, it can be said with certainty that the times are changing. Against the backdrop of a series of sanctions imposed by the United States of America under the leadership of Donald Trump against Russian oil and gas giants such as Rosneft and Lukoil, a domino effect is beginning for Asia's largest energy buyers. It is Asia, and primarily India and China, that has found itself at the forefront. These countries have long benefited from advantageous Russian energy supplies, cheap oil, favorable conditions, stable ties. But now, after new US sanctions and threats from Washington, Moscow is no longer the free supplier it once was. The United States has effectively declared that if you continue large-scale purchases of Russian oil, prepare for serious consequences. Many believe that the goal is not only to deprive Russia of revenue, but also to undermine the strategic dependence of India and China on Russian raw materials. What is interesting is that officially, India and China publicly declare that they will reduce dependence on Russia, seek alternatives, and will not violate sanctions. But according to insider reports, the situation looks very different. Several independent sources indicate that Indian and Chinese structures, directly or indirectly, are already developing a mechanism that allows them to bypass sanctions and maintain previous supply volumes until the end of autumn. This mechanism involves negotiations on a new financial architecture, settlements in national currencies, the use of shadow transport corridors, and changes in logistics schemes. While the world listens to official statements, "We will not buy Russian oil, we support sanctions," another game is being played behind the scenes. India, China, and Russia, through their alliance in BRICS, see themselves not just as trading partners. They see themselves as a potential counterbalance, a bloc capable of challenging US economic dominance and the dollar's position as the key global currency. In its latest analytical review, the reputable publication The Guardian noted that because of sanctions, Russia's oil purchases by India and China have sharply decreased, but only officially. The true situation, according to experts, remains hidden. This is why there is now such heightened interest in what is happening in reserve. As reported by the trade publication The Times of India, the new US sanctions on Rosneft and Lukoil, with their broad-reaching implications for not only Russia, but also its buyers, have become a powerful lever of influence on India and China. But there are a couple of key points that are almost never covered officially. First, the rejection of the dollar in energy settlements is a long-running topic, but it is precisely this issue that is now being actively considered. Negotiations are already underway for settlements between Russia, China, and India in national currencies, or through alternative payment systems. One insider close to energy circles noted that they are preparing for a scenario where the dollar loses its monopoly over international settlements, and that moment is approaching. Second, there are signs that India and China are not simply waiting for sanctions to fade away, but are working to buy time and preserve the status quo until the end of the year, despite their public statements. For example, in India, there is talk of stopping imports of Russian oil through direct contracts with Rosneft and Lukoil, but through intermediaries and alternative routes, oil continues to flow. In fact, we are witnessing a double game. On one hand, India declares that it will follow sanctions and will review import structures. On the other, behind the scenes, mechanisms are in place that allow it to maintain energy security, cheap oil, stable supplies, and a strategic partnership with Russia. For India and China, what truly matters is not slogans, but ensuring economic growth, minimizing raw material costs, and supporting industry. And if Russia has traditionally been their convenient oil supplier, it is now, under sanctions, turning into a strategic partner with whom cooperation can be more flexible if bypass mechanisms are created. Meanwhile, the US sanctions, intended to deprive Moscow of revenue, are facing a global market that is unprepared for circumvention scenarios. As Reuters notes, Chinese state oil companies have already suspended purchases of Russian seaborne oil after US sanctions, but more out of caution than overcompliance. They are waiting and assessing risks. Here lies the key point. A complete abandonment of the dollar, a full rejection of US financial mechanisms, is not yet ready. The world cannot restructure overnight. Both India and China officially are not renouncing the dollar, the Western banking system, or participation in the global economy. But they are preparing for a scenario in which part of the energy supply chains moves out of the West's control. And this preparation is the central storyline. For the United States, this represents a serious trap. If India and China begin to ignore sanctions on a large scale, or create a shadow around them, and if transactions and deliveries start bypassing the dollar system, a significant portion of the global economy could slip beyond direct American influence. In that case, the dollar would weaken, financial flows would shift, and the United States would lose part of its economic leverage. These are precisely the risks now being discussed in classified reports by American analysts. But these countries face a major limitation. They cannot completely detach from the Western financial system right now. The risk is too high. A sudden break from the dollar or from Western banks would be shooting themselves in the foot. The global economy is too interconnected, and if India or China were to take such a step without preparation, the consequences would be catastrophic. Therefore, they are moving slowly, cautiously, but deliberately. There is another factor in this story: the alliance through BRICS. Russia, China, and India are all members of this bloc. Their relations have long gone beyond mere oil trade. They encompass politics, security, joint infrastructure projects, and a new financial order. This often remains behind the scenes, but it is precisely this multi-layered interconnection that forms the foundation for the actions now coming to light. And here is what matters. By the end of autumn, if the sanctions bypass mechanism is launched, India and China will fully restore supplies of cheap Russian oil and gas, bypassing direct contracts with Rosneft and Lukoil and avoiding direct use of the dollar. Western sanctions will become only a formal barrier. Inside, an alternative logic will function. Then it will become clear that India and China are no longer merely reactive states under US pressure. They are becoming active participants in the transformation of the global economy. For the United States and the Trump administration, this means that the strategy of pressure through sanctions and dollar control may be losing effectiveness. And if Washington does not anticipate this shift, the consequences could be far deeper than just reduced Russian oil purchases. It will mark the beginning of an era in which energy, finance, and currency structures are reconfigured. In conclusion, we are witnessing not merely a trade clash or a temporary crisis, but the preparation of a new order. India and China are not rushing to loudly declare a challenge to the United States. They act quietly, patiently, strategically, but their moves already signal that they are ready to oppose unilateral US and dollar dominance. And if the bypass mechanism is activated, by year's end, the world may look very different from what we are used to.